Hi, I'm Max Keiser. This is the Keiser Report, reporting to you of the global financial war that's raging in country after country. Let's bring in Stacy Herbert.
Max, I think you're referring to the currency war that we've been warning about for years now. First headline, global currency war takes a dramatic twist. Now this is, of course, the currency war relating to the Swiss franc, when they've now abandoned the floating exchange rate. But in this article is an important quote from David Bloom of HSBC that I want to refer to, Max. Gold is the only safe haven asset that will not do QE, put in capital controls, or complain.
Well, Stacy, you've got this global game of musical chairs, or as I like to think of it, pass the grenade. Money is seeking safe harbor, and they're moving to currencies that have the perception of being safe harbors, like the Swiss franc. But now that's no longer a safe harbor. So money is being driven into the Norwegian krone, and to some extent the Australian dollar, and maybe a little into the Canadian dollar. But those currencies, too, will collapse. All fiat currencies will collapse. Now, while this is going on, the various bodies that regulate and oversee the trading of gold and silver keep raising the margin requirements. They are, in effect, creating a de facto gold standard by trying to stop the creation of a de facto global gold standard.
But the reason why we were able to predict this is because history always rhymes. And as we said, this is the biggest financial catastrophe since the Great Depression. And we know exactly what happened in the Great Depression is after a few years of market collapse, there was, of course, global currency war.
That's right, but during the currency war of that era, of course, the world still had a gold standard. And now we're not on a gold standard. So the currency war takes on a dimension of lunacy.
Speaking of three-ring circus, and I want to bring your attention to Nigeria deals the dollar another blow. So this has happened the same day, actually, that the Swiss introduced this currency peg to the euro. So this didn't get much attention, but on September 6th, Nigeria's central bank transferred a tenth of its $33 billion of foreign exchange holding into yuan.
That's right. All of the bilateral deals between Russia, Iran, China, Nigeria, who?
Nigeria.
Oh yeah, they're doing a deal also, bilateral, outside of the dollar. And the dude responsible, like this big banker dude, he says, we don't need no stinking dollars.
Well, let's turn to a clip here with Reuters and where he explains why they've done this.
Strategically, we think that it's inevitable that the world will recognize RMB as a reserve currency. I don't know how long it will take, but China is the second largest economy in the world. It's got a very huge amount of reserves. It's in a very strong financial position vis-a-vis vis-a-vis other large economies, and it's more or less in the same situation the United States was in after the Second World War, when other large economies were hit badly by fiscal deficit positions. So we do think it is a wise move at this point in time.
Yeah, the RMB will be the reserve currency. We've known this now for a few years, and China is just playing a cat-and-mouse game with the dollar. They are secretly hoarding gold. We know this from WikiLeaks cable recently that just came out. They have been secretly hoarding gold. They have their minions all over the world sucking gold out of every little orifice of the global economy that they possibly can, and they need another 3,000 or 4,000 or 5,000 tons of gold.
Yeah, and again, this is part of that trend, which we've talked about, is it's just the currency volatility, the financial volatility, is we're seeing the collapse of the American empire. But let's turn to this other clip here, because this is very important.
Now, Nigeria currently sells oil to China. How do those oil sales tie into your reserve decisions here?
Well, at the moment, all sales are invoiced in dollars and we get paid in dollars, and that's what goes to reserves. So, for example, if the Ministry of Finance has no objections, we could request that all sales to China are paid for in RMB, now that the Chinese government has allowed RMB for settlement for such transactions.
So, Max, what do you think of this? Because this is always the thing backing the U.S. dollar. The only thing backing the U.S. dollar at this point is oil. So, what do you think will happen if Nigeria starts trading in yuan?
Well, this is, we've talked to economists like Michael Hudson or Catherine Austin Fitts. They say what backs the dollar is war and oil are pari passu, so to speak. So, yes, as the warfare state of America collapses, then that puts additional pressure, downward pressure, on the dollar. It's holding up relatively well. And my theory there is that 90% of the dollar buying is done through high-frequency trading, algorithmic trading, computer trading, and this is all done really through the shadow banking system, and this is why the U.S. debt keeps ballooning off balance sheet to the hundreds of trillions of dollars, because they're out there supporting the dollar until such time as they can't support the dollar anymore, and then you have an Enron implosion-like situation and hyperinflation overnight, and people will ask, well, how did that happen? Paul Krugman at the New York Times will be like, oh, I never saw that coming. How did it happen?
Well, John Foley of Reuters says that despite Nigeria's bold move, China's currency still has few of the qualities of a credible reserve currency. And here are two of the qualities he says are necessary for a reserve currency. One, low inflation is usually a prerequisite, yet China's runs at above 6%. I want to turn our attention to Shadow Stats inflation numbers. And as you can see, the red line is the official number, so it's always well below 6%, of course. But the blue number up there is that based on how the U.S. used to calculate consumer price inflation before 1990, when then President Clinton came in and manipulated it. But as you see, right before the financial collapse, inflation in the U.S. was almost 15%.
Right, so inflation in the U.S. is well above 6%, so that argument doesn't hold water.
That's exactly correct. And then he says, stable monetary policy is another typical condition, yet China lacks an independent central bank. So, you know, again, referring to that chart, on the left-hand side of the inflation in the U.S., you saw that inflation was 15% in 1980 until Paul Volcker raised interest rates to 20%, crashing inflation back down to closer to 0%. Now, this is what Paul Volcker says about what central banks add to stability of a monetary system. It is a sobering fact that the prominence of central banks in this century has coincided with a general tendency towards more inflation, not less. If the overriding objective is price stability, we did better with a 19th century gold standard and passive central banks with currency boards or even with free banking.
Yeah, the Federal Reserve Bank in the U.S. is not independent by any stretch of the imagination. No independent body would independently suck up $2.5 trillion in toxic debts from Wall Street. That's not what an independent thinking Fed would do. They're in the control of Wall Street. And so again, the arguments against the Chinese yuan being the world reserve currency don't hold water. The U.S. dollar, using those very metrics, looks like a pig dressed up with a bunch of lipstick. A pig wearing lipstick. You know, the dollar is really the leper with the most fingers. It's the prettiest horse at the glue factory. You know, it's just being held up with sticks and scotch tape, and once it blows, it's like Mount Vesuvius. Gold will skyrocket.
Well, gold is already skyrocketing. But again, this is the global currency war. We're moving on to another headline about another currency. UBS declares the euro should not exist in a monster report on the odds of an EU breakup. This is UBS's Stefan Dio, Paul Donovan, and Larry Hathaway, and they've released a report in which they examine what would happen if a euro broke up. So the consequences is if a weak country left the eurozone, so like Italy or Greece or Portugal or Spain, it would result in their economy of up to 50% GDP collapse in the first year. But then they go on and say if Germany left, it would result in a 20 to 25% collapse in their GDP. It would also cause the global trade to collapse.
UBS is in the business of churning people's accounts unmercifully to make UBS brokers and bankers money. Every day they come out with a new story, and it's usually a contradiction of the previous day's story. If you listen to UBS or any of these other bankers, you're going to lose everything because they're fraud. They're complete and utter fraud, and they've been shown to be fraudulent 19 different ways to Sunday, and that's not going to change. Their business model is fraud. All these banks, same thing.
So speaking of varying costs for bailing out systems or bailing out people, let's turn to the UK, Max, because I have these two headlines here, interesting contrast. England riots to cost taxpayers at least $133 million in policing and compensation. So this is in the UK, and the rioting cost £133 million. People are up in arms about this, but if you contrast that to the headline, UK financial bailout reaches £1.4 trillion, this is from April of 2009, and the cost of the banking bailouts was £1.4 trillion, but contrast the response from the population in the UK to the $133 million cost of the rioters compared to the banking rioters.
Well, in the UK, the problem is, and you see this all over the world, victims are very reticent about talking about their experience.
In a Ponzi scheme, this is what police find often, that they'll approach the victim of a Ponzi scheme to tell them that they are a victim of a Ponzi scheme,
right.
And they always deny it.
They deny it. So this UK person, the subject of the Crown, I was going to say citizen for a second, you know, they would be upset that a stick of gum was stolen, and they'll call the police. Oh, police, a stick of gum was stolen. But if they had their entire mortgage defrauded and their house lost due to George Osborne's friends in the city, they're quite embarrassed and ashamed about it, and they won't want to tell anyone or lose face with their neighbors. And people in the banks know this. This is why they know that they're not going to be prosecuted or caught by committing in UBS and the others, defrauding millions out of trillions.
And the other thing is that, remember when all these riots were going on in the UK, the media was certain that they were all gang members. Well, actual analysis of the people arrested and in jail is less than 20% of them were gang members. And yet, contrast that again with the banking riots. 100% of them are proven to be part of a racket, a global fraudulent debt racket.
That's why I say give these rioters broker's licenses. You know, grow your economy by leveraging genuinely talented people who know how to rape and plunder. UK? It could be a good show on Channel 4. Rape and plunder in the city by rioting looters. What could be better? All right, Stacy Herbert, thanks so much.
Thank you, Max.
Don't go away. Much more coming your way. So stay right there.
Permission free. Accreditation free. Transport charges free. Arrangement free. Risk free. Stereotype free. Download free broadcast quality video for your media projects at freevideo.rt.com.
Hi, I'm Max Keiser. Welcome back to the Keiser Report. This is the book you've got to get. It's called Debt, the First 5,000 Years. All right, let's talk to the author. David Graeber, welcome to the Keiser Report.
Thanks. It's great to be here.
All right, David Graeber, which came first, debt or money, and how do you define the two?
Well, if you define money really broadly, I suppose in a certain sense it's always been around. It's one of those things that, you know, wasn't really invented at all any more than, say, music or clothing. Money is just a way of saying 12 of these are worth 2 of those. It's a way of measuring proportional values, I guess you could say. Debt, on the other hand, is when you take a promise and turn it into money. When you take a promise that can be precisely quantified, and because it can be turned into money, turned into mathematics, you can transfer it from one person to another. I mean, normally if I make a promise to someone else, I can't you can't sell my promise to a third party. That's what makes debt so special. It's impersonal. It's detached from any actual human relations. So in that sense, money had to come first, but the odd thing is that we're used to thinking of money as coins, and that didn't come first at all. In fact, cash is really a latecomer. Money actually originally took the form of credit and debt.
Okay, so in other words, you're saying money, you use the term proportional value, or I guess you could say barter. There is a bit of a barter element there, versus debt, which is the beginning of what we now call derivatives. It's a representation of something that you can buy and sell independent of any underlying value. It has its own separate kind of parallel universe, if you will, in the scheme of economics, correct?
In a sense, although you got to be careful with the term barter, because we're all taught that, first, once upon a time there was barter, and then you get money, and after that we get credit. But actually that story is, if anything, backwards. There's no example of an economy where people sat around and saying, well, I'll tell you what, I'll give you 20 chickens for that cow. Actually, people did each other favors. In a real society about money, the way anthropologists such as me has observed, what people do is they say, wow, that's a really nice pig. And then you say, oh, no, I'll give you the pig. Don't worry, it's on me. It's a present. And then, of course, you owe somebody something. You owe them a favor. The question is how you go from that. There's communities where everybody owes each other favors, which is sort of the way communities are supposed to work. There's something where you say, you owe me exactly 27 of these, or I owe you 32 of those. And that does not seem to have happened through barter. That seems to have happened through legal systems, through temporal redistribution, a million different ways. But the story the economists tell is clearly not it.
So for the past 5,000 years, we have moved back and forth between this virtual money or debt-based system as we have today, and or as we had in the beginning, and hard money economies like gold and silver. So what's the difference between these two periods, and how do they ebb and flow through history? How do we make the transition from back and forth?
Well, that's a really interesting thing, and I didn't really anticipate it when I started my research. But what I found out is, at least if you look at the history of everywhere from Europe to Asia, there's a kind of a shape to history, an ebb and flow. Credit money is the original form of money. You already have expense accounts, bar tabs, fluctuating interest rates, or compounded interest rates, long before the invention of coins. Then around 700, 650 AD, you get the simultaneous invention of coinage in India, in China, and first of all in the Mediterranean. Now, the amazing thing is that this isn't really an economic innovation. The Phoenicians, for example, were the great traders of antiquity, didn't even use coins until very late. It was mostly to pay soldiers. And actual cash, it makes sense if you think about it, because if you have a bunch of marauding people stealing gold and silver, well, that's the first thing they're going to carry off, you kind of move to a cash system. A soldier is the last person you're going to want to extend credit to if you're selling things. And in periods of war, empire, and slavery, you move to cash money. For about 1,000 years, that was the case, from maybe 500 BC to 500 AD. It was a period of giant empires. The empires used cash to pay their soldiers. When the empires go away in the Middle Ages, so does the cash. It all gets locked up in temples, and people go back to credit systems. Again, we're used to thinking, oh, they reverted to barter. No, it's not true at all. Across from Europe to China, people were using complex credit systems, which were denominated in money that no longer actually existed physically most of the time. So you have paper money, you have checks, you have tally sticks they're using in England. Then, of course, 1492, you get all the gold and silver coming from the Americas. People move back to cash. You actually have the reappearance of huge empires, slavery. That's the period we're moving out of now. Since 1971, if you just want to choose an arbitrary cutoff date, that's when Nixon went off the gold standard and the dollar was definitively detached from gold. So this is not a new thing, virtual money. It's actually, in a way, reverting to the original form of money.
So how does the current era now, so walk us through what's happening now. We're in a transition period right now, correct?
Exactly. And one of the things that I found most disturbing when researching the book is that what we've been doing is going about things backwards. If you look at the history of credit money, starting in Mesopotamia, there was always some system in place to protect debtors. And it makes sense, because if you have virtual money, if money is just an IOU, it's just a promise, an arrangement between people, not intrinsically different than any other promise you might make. Well, the big problem is, first of all, how do you make sure things don't go completely out of hand and people just start making crazy promises they can't keep? And two, how do you make sure that essentially most people don't end up becoming literally or figuratively slaves to the people with the money? That was the great social crisis of antiquity. It was always the fear of a debt trap. Poor people would fall into hopeless debt to those people who actually had the money. They would end up having to sell off their lands, their flocks, eventually, their wives and children and themselves into slavery, or debt peonage. So the response was normally to put in some kind of mechanism, a failsafe. In Mesopotamia, kings would simply declare a clean slate. All debts are canceled. Biblical Jubilee, of course, every 7 to 49 years there was cancellations. Now, so usually silver debt, which was commercial debt, was left alone, but consumer debt was wiped out. Everybody just start over again. Now, in the Middle Ages, they had a different tack. They mostly had usury laws, so lending money at interest was illegal. Also, debt peonage itself. So there's always some kind of mechanism to protect debtors. Now, what happens this time? First thing they do, they get rid of the usury laws. They create institutions like the IMF, or adopt institutions like the IMF as a sort of global debt enforcer. Other ones like the S&P. You have this giant global bureaucracy, essentially, financial bureaucracy, which is dedicated to the principle that no one can ever default. This is crazy. I mean, not only economically is it crazy, but it's doing exactly the opposite of what people have historically done. And if you look at the results, well, it looks an awful lot like that terrible debt trap that everybody was afraid of throughout human history.
So if I hear you correctly, you're saying that for the first time in 5,000-year history of debt and credit, we're in an era now where institutionally the creditor is protected versus the debtor.
Exactly. In fact, they've made bankruptcy laws more difficult. They've made lending at interest easier. The usury laws that we did have were essentially abolished in the beginning of the 80s here in America. And similar things happened all over the world. Suddenly you move from the sort of welfare state model where people can get social benefits to this idea where, well, you can get credit. Credit is supposed to save the world. Everyone has 401ks, everyone has mortgages. The poor in the third world are going to be saved by microcredit. Meanwhile, the terms of the credit are skewed hugely in favor of the creditors over the debtors. Now, the result is that most Americans, I always like to make this point, are in a position which looks a lot like that social disaster that everybody was afraid of. If Aristotle were here today, he would think the distinction between someone falling into debt and selling their children into slavery and someone in debt renting themselves and their family into to work for somebody else would be probably a legalistic distinction. Now, on the other hand, I think there is reason to hope because, well, I mean, we're talking 500-year cycles here. 40 years is nothing. I mean, maybe they got it wrong the first round, but there's a lot of room to fix things up.
Okay, well, on this area of subject of hope, I was just looking on the web and stumbled upon a story about Kiva.org, which is a peer-to-peer lending site, and over 350,000 individuals in the first world have loaned money to 350,000 people in the third world, microloans, and exactly what you're saying was going on 5,000 years ago. They've extended credit and at terms that are reasonable, and they have boosted the economy in huge ways. So, I mean, that's a hopeful sign, I suppose you could say, if that model could be embraced on a slightly larger scale, correct?
Absolutely. I mean, there's a million solutions. I mean, the one thing the world doesn't lack is smart people. If we put our minds to this, it would be very easy to come up with alternative money systems, alternative ways to arrange these things. I have friends in Asheville who've set up alternative money systems with software that sort of anybody can use, and they've got thousands of people already hooked in who hardly use cash at all in their anymore. They simply exchange things directly with each other. And there's a million ways to do it. And the other thing is the political mobilization. Because the real problem isn't that the lack of alternatives. The real problem is the fact that anything is going to be cut off politically. And that's why I think what's happening in Europe is very hopeful. What we have in Greece, what we have in Spain, and it's beginning to spread to other countries. And the way I like to think of it is, I think in 2008 they kind of let the cat out of the bag. You know, for all these years they've been saying markets run themselves, the people in charge, they know what they're doing, they might not be very nice people, but they're incredibly competent. In fact, they're the only people who know how to run an economy. And of course we were also told debts are sacred and have to be repaid. What we learned with the crash was that none of those things were true. People had no idea what they were doing, they did get bailed out, markets didn't run themselves. So once we understand that money is actually a political arrangement, it's a social set of promises that people make to one another, well, and, you know, if trillions of dollars worth of debt can be made to disappear if that's convenient for the big players, I think what people are saying is, well, oh, right, fine. If those are the new terms, that makes sense. But if democracy is going to mean anything now, it means everybody gets to weigh in on how promises are made and how they're renegotiated. And that's what people are calling for and demanding. And I think it's very promising for a sort of new political movement.
Actually, I have one more question. This is from Twitter. And if you want to ask guest questions on this show, go to my Twitter account at Max Keiser. And this is from Read the People. The question is, are you arguing that money, quote, in a sense of exact equivalence, end quote, is based on coercion, not voluntary exchange?
I think that it originally emerged in that context and has been maintained remarkably much through that context. If you look at, you know, where the first circumstances where people started commuting values and figuring out that 27 of these equals 3 of those, it was mostly in legal cases and situations of potential violence. I think that coins have been promulgated through military systems, and I think that the current dollar system is closely tied. I mean, look at the international currency system. The international currency is the currency of the largest military power. That's not a coincidence.
All right, David Graeber, we're going to have to stop there. Thanks so much for being on the Keiser Report.
Thanks for having me. It's been a pleasure.
The book is called Debt, The First 5,000 Years. I recommend you pick it up. That's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, David Graeber. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.